Welcome to this episode of ACG's GrowthTV. Today, we're examining the world of impact investing with Michael Korengold, President and CEO of Enhanced Capital. Michael, as an impact-focused firm, what are the areas in which Enhanced Capital is trying to make a positive difference?
Well, first, Carolyn, thank you for having me. It's great to be able to talk about this topic. We focus on three key verticals. One, small business finance, where we're financing businesses that are located in underserved areas. So think of low-income communities or highly distressed areas, or the rural parts of states. Businesses that are owned or led by women or people of color, and businesses that promote environmental sustainability. So that's one vertical. We also have an impact real estate group, which typically finances community revitalization efforts. So in this case, picture an old factory that perhaps has been laying dormant for years and years. And with our financing, it can now come back to life, maybe be a boutique hotel, a mixed use property, perhaps assisted living. And then last but not least is the fastest growing vertical of ours, which is our climate finance group, which finances renewable energy installations, energy efficiency upgrades in existing and new builds, and brownfield remediation.
Measuring and tracking non-financial returns continues to be a challenge that we hear from investors. How do you track the impact on the focus areas you just mentioned? What systems, benchmarks, best practices, or metrics do you use?
It's a great question. And we've been at this now since late '99, long before ESG and impact investing had sort of the conversation around them that they do today. Back then when we started, we measured impact in some of the same ways we do today, which is job creation and retention in the small businesses that we invest in. The number of businesses that do have women or people of color in leadership roles or as owners. And even more than 10 years ago, really tracking environmental sustainability. A lot of those same concepts are the way that we measure impact today. But happily, there's been just a more consistent growth in accepted frameworks for measuring impact. So we have an impact framework. We measure everything according really to four themes. Is there an economic development or job creation aspect? How do we impact underrepresented communities? How do we impact underrepresented populations, again, women, people of color, and then what is our impact on environmental sustainability? And as many people are now familiar with, there's the United Nations Sustainable Development Goals, the UN SDGs. And like many impact investors, we measure all of our investments according to one or more UN SDGs. And if they don't fulfill any, then we wouldn't be able to make that investment. So that's how we track everything. We then get very granular, with each of our portfolio companies. We ask them to report to us, not just on their economic performance, how is our investment doing, but on the impact performance. How are all the metrics being satisfied? What were the jobs at the time of our investment? What are the jobs today? How many people have they hired? What are the populations of the people that they've hired? What has the impact been in their community? So in many ways, it's evolved a lot, but it's still consistent with how we got started over 20 years ago.
How have you heard LP investors respond to the impact investing opportunity? What are some of the barriers you've run into in your investor conversations?
It's really interesting. In the last several years, we've watched LPs become significantly more sophisticated on the topic of impact investing. Many years ago, when impact investing was just more of a kind of concept, but hadn't really become fully formed to the extent it's fully formed today, LPs were a little bit all over the place. Today, that's not true. They're all sensitive to greenwashing and firms that have held themselves out to be impact investment firms when in actuality, they're really not. They may have made some historical investments that checked certain boxes, but that obviously doesn't make them an impact investment firm. And what we tend to observe now is that LPs are armed with a lot of the material, that a lot of the third-party organizations have been putting out for years. They read the community impact reports from firms like us and other impact investors is a very good place to measure new firms against. And they come in with a pretty solid knowledge base. I think the other thing that's happened with the LP base is a greater understanding of the firms that are concessionary, where they make a trade-off on the returns that they might generate because of the impact that their investments have, versus firms that aren't concessionary, where they're trying to generate a market rate return. At the same time, they're still delivering on their impact, predictable impact results. So, investors line up into different groups. But overall, we've been really pleased by how sophisticated the conversation has gotten with LPs on the impact front.
Michael, thank you so much for taking the time to speak with us today.
Thank you, Carolyn. It's been a pleasure.